So great article in Bloomberg today. I thought I'd summarize it. It's how the rich pass wealth to tax-free here. I don't want to have any sort of copyright issues. So here's the article, The Hidden Ways the Ultra-Rich Pass Wealth to Their Heirs Tax-Free. It is from Bloomberg. You can see up there. And we're going to cover the structures that they mentioned. First, a little background. I'm a real estate attorney and a broker. Wealth planning facts. You can get $15,000 a year tax-free without reporting it to the IRS. So parents could give to their daughter and her husband $15,000 a year, which when you go from one parent to the husband and the daughter, and then from the other parent to the husband and the daughter, that's $60,000 a year tax-free. It's a very good vehicle. I think many people are aware of that. The lifetime exemption in 2021 is $11,700,000. It'd be double that for a married couple. If you have not gifted money and reported to the IRS in the past, then that's available to you. This is absolutely a legit, it's talked about in the article. Over at winnerscheck.org, we help people. Let's say you're looking to buy an income property and you'd like some help from grandparents or parents. They can gift money to you up to the 11.7 or 23.4 for married couples to you to help buy those properties, and you can do it tax-free if the proper formats are followed and you report Form 790 to the IRS. Now, the article discusses some of that, and then they go into these 4 structures that the wealthy use. Now, setting up a GRAT, you set up for your heirs and your beneficiaries. You place the assets in that you would anticipate appreciating quickly. The heirs will get the appreciation minus a small amount, sort of like interest, which is a very low rate right now, that would go back to the grantor. And the grantor, if there were taxes due, would be paying the taxes due. So if they're trying to get money out of their estate and into their heirs' estates, it's great that they're paying the taxes if taxes have to be paid. And let's say they put IPO stock in there. They could see 5, 10, who knows how much the IPO stock appreciates. They could see a massive appreciation in the GRAT that would go to their heirs tax-free. So that's an awesome vehicle. And the little bow they put on this in the article is that they mention that the wealthy could and do keep creating GRATs over and over and over. And therefore, you can see that it may be hard to know when the stock market's about to boom or when you're going to see your assets appreciate quickly, like we have seen assets appreciate over the last year or two. But if you keep setting up those GRATs, the article says if the appreciation doesn't happen, you can just pretend the GRAT never existed and try again. So that was a nice wrinkle. Now, this is the minority valuation discount. This is a pretty simple idea. It makes a lot of sense in a, let's say you had stock in a publicly traded company, but it was a small company, didn't trade that many shares per day. And if you were to put all your stock on the market at once, it would collapse the stock. So when you're putting your stock into the LLC, and then the LLC is owned by sub trusts, those trusts' valuation of that stock could be significantly less than the value of your shares because they couldn't be all sold at once. In article, they talk about how Phil Knight did it and allowed his son Travis to purchase Nike shares at a 15% discount, which when you're dealing with the numbers they were dealing with was a significant tax advantage. But I think an excellent example they use in this article, which I had already been thinking in my head, was let's say you have an apartment building that you can't really alienate parts of it. So the apartment building goes in the LLC. Your heirs have trusts that have shares in the apartment, equal ownership of the apartment building. If they tried to alienate that, they probably wouldn't get the full value of it because they might not be able to force a sale because they don't have a controlling interest. So you could easily see that the shares, the smaller trusts would not have full value. It was discussed you could 40% discount. So let's say it was a $10 million apartment building with 5 heirs. Normally it'd be $2 million, but you could see a 40% discount on that, so it might be $1.2 million. But later on, when all the heirs got together to sell, they'd instantly get that 40% appreciation tax-free. Now, well, here's where we talked about the Travis Knight thing. Charitable remainder trust. There's many different variations on this theme. But here was the set up a split interest trust. This was mentioned in the Bloomberg article. It's particularly good, they mentioned, the low interest rate environment because the IRS assumptions of how much interest should be paid out causes the fact that you can see low payouts for 10 to 20 years out of the trust to the charities. And then at the end of the period of the trust, your heirs can get that whole amount that you put in tax-free. Additionally, and this is the wrinkle, the aggressive wrinkle, like if you were wondering why the Trumps and all these other people are talking about their charitable foundations and in New York, they're going after them, but why are all these setups? You can see that Bloomberg mentioned the money can flow out to family foundations, which can pay out as little as 5% a year to the charity, presumably the charity, or a donor-advised fund, which may have no such requirement at all. So you set up these charitable remainder trusts. Your family gets paid to administer them. They only pay out a little bit, and then they get the appreciation at the end of it. Seems to be what this Bloomberg article is implying. And now the Dynasty Trust. You file, we're doing some remodeling in the background. If you hear it, I'm going to wrap this up quickly. You file in a state like Delaware where there's no expiration date on the trust. You place money into the trust, presumably without, or they said without triggering a tax bill. So maybe that's the $11.7 million in 2021. Then that trust does business with you. And this is a quote. This seems pretty aggressive, but once from the article, once you've seeded your Dynasty Trust, set up transactions between it and other entities you control, including GRATs, or your own bank or investment accounts. These deals should appear on paper to be legitimate deals, but the terms can be as generous as possible. A Dynasty Trust might buy an investment from you for only 10% of its value with a promise to pay back the rest eventually. There's no limit on how big the trust can get. So presumably, again, if they promise to pay it back, the shares depreciate, they could give the shares back, right? So these are some of the ways the wealthy pass on taxes, pass on wealth tax-free. I will cover this more in future videos. My name is John McConnin. My website that deals with this in the context of real estate is winnerscheck.org. Thanks. Talk to you later. Bye. Thanks for watching. And once again, let me just pull that Bloomberg article over in case you want to read it. So it's the hidden ways the ultra-rich pass wealth to their heirs tax-free. All right, thanks.